Hello everyone, please let me know if you can hear me. Hi Marcus, hello to you, and please give me a signal that I'm streaming and that I didn't mess up today. Waiting for your feedback to start because I need to know if I have sound, if I'm streaming. Yeah, okay, Marcos can hear me, so thank you very much. So let's begin then. All right, so let me change chart here. Let's use this one. Okay, so today we're going to finish with the topic of impulses. Actually, yesterday we pretty much finished with the topic of motive waves because we covered diagonals, and of course we have covered impulses. So now we're going to finish with the topic of impulses. Good evening to you, good afternoon, and good morning to wherever you are. No sound there, I'm sorry to hear that, but other people are saying we can hear you. Now I can. Okay, great. All right, so let's begin with the impulses so we can close this topic and then move on. Basically, all impulses typically show an extension. What's an extension? You know, I have discovered that the Elliott wave principle is, as I have said many times, extremely simple. It's basically going back to kindergarten where you learn how to count to 5 and then you learn your ABC. But it's not easy. And the jargon of the wave principle is probably more complex than it should be. So when we talk about extensions, it sounds like something weird, when in reality, an extension is simply a wave that is longer. That is all it is. So typically when we see an impulse, one of the waves is longer than the other. You probably remember that I think it was precisely in this market, where we labeled, here. You probably remember we labeled that was in the weekly. We labeled these as, let's do it again. We said this is 1, 2, 3, 4, 5 for 1, and then 2, and then 3, 4, and 5, of course. Now, notice that in this case, the 1 is longer than I typically draw them, right? It's longer than 3, it's longer than 5, but 3 is not the shortest, and that's what matters, because the rule says that 3 can never be the shortest. So now let's go back to that drawing I was making. Yeah, so here I drew one with the 3 extended, right? But, or let's say longer. Let's use the word extended. Now there is a possibility that the wave 1, as you saw now, is the one that extends. In which case, wave 5 must be shorter than wave 3, of course, because remember, wave 3 can never be the shortest. And there are situations where wave 3 is not the extended one, but wave 5 is the extended one. And I believe we had that situation in another one of the stocks that I showed you. I think it was NAV, and somebody asked me, why is the 5 longer? At the time, I didn't want to complicate things by explaining the extensions. But basically, this is all it is. An extension is when one of the legs of an impulse is longer. Now, that typically is the case. In other words, we hardly ever, if ever, find an impulse where waves 1, 3, and 5, all the actionary waves are the exact same size. So one of them is typically longer. Now, this is the interesting part. As you know, all of them should have 5 legs, right? We have covered these to exhaustion, right? All of them must have 5 legs. So what it is that during extensions, it is possible that the extension itself extend within. In other words, there are extensions within extensions. So let me draw that for you. But first, let me clarify something. Extensions typically add 4 legs to the entire structure. For instance, I'm going to draw this again, but with the definition of the extension, because all of them must have 5 legs, but not all of them show, right? The extended one typically shows. Why? Well, because it's extended, because it's bigger, because it's longer, and then it's easier to see the subdivisions. So you can see here we have 1, 2, 3, 4, 5. And this is the same here, 1, 2, 3, 4, and 5. But if we count all the wiggles of the extension, then we add 4 to those 5. So we will have 1, 2, 3, 4, 5, 6, 7, 8, 9. So impulses typically have 5 legs, right? But when they have extensions, which is always, they actually show 9 legs. And it doesn't matter where the extension is, whether it is on the first leg or on the 5th leg or the 3rd leg, as in this case, they end up showing 9 legs. So in this case, it would be 1, 2, 3, 4, 5, 6, 7, 8, 9. And in this case, it would be 1, 2, 3, 4, 5, 6, 7, 8, and 9. Okay, so basically, when we go to a chart, I didn't bring the chart of nav again, but that one shows very clearly the extension. And if you can go back to that presentation where I showed you the nav chart, I believe it was on day 2, then we counted the internals. And you could see that if you were to count all of them, instead of counting 5, you would be counting to 9. Now, here's the interesting thing. Sometimes it is impossible for us to see which one of the legs is extended. But all we see is something that goes like this. Basically, we have 1, 2, 3, 4, 5, 6, 7, 8, 9. So if we think, well, maybe the 1 is extended. 1, 2, 3, 4, 5. This is 1, right? This is 2. This is 3, 4, and 5. But maybe it's not the 1 that is extended. Maybe it's the 3 that is extended, and the 1 goes here, and the 2 goes here. And still we have 1, 2, 3, 4, 5, 6, 7, 8, 9. And so the 3rd here would be extended. And we could say the same if it were the 5th leg. So maybe this is 1, 2, 3. This is 4, and 1, 2, 3, 4, 5. So that would be 9 again. So sometimes when it is impossible to differentiate the legs, sometimes we just count the number of waves. And when we count to 9, we pretty much can assume that that move is impulsive. And the same occurs when there are extensions within the extensions, which is what I was going to draw. For instance, we have, let's say, wave 1, we have wave 2. Now let's say that we have a wave 3 that is extended. We have 1, 2, 3, 4, 5 for wave 3, then we have wave 4, and then wave 5. So wave 3 is the extended leg. Again, what does it mean? It's the bigger leg. It's the longest leg, right? But within the extension, which is wave 3, there is an extension. You can see that wave 3 of 3 is also extended, is also longer. So then we will find that wave 3 of 3 would have all the subdivisions there. And then we would have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. In other words, we would be adding 4 to the 9. Basically, extensions are always adding 4 legs. And again, for those of you who asked me about Fibonacci, there you have a Fibonacci number again. So this thing continues because we could have a situation where, actually that happens very often, where the legs are not so clearly differentiated, and all we have to do is to count the waves. We say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. And when we see these, we can assume, well, there are 13 waves there. Likely, very likely, this is an impulse. Particularly if they are not overlapping. Of course, we cannot say the same if we get to have something like this, right? And then they are all overlapping, then they lose the personality of the impulses. And you know how I define them as thin, slim, elegant, fast, non-overlapping, etc. So we cannot lose the personality of those legs, particularly because the extensions within extensions and the extensions themselves must follow the rule. Okay, so let's see what that means. We have the normal impulse with 5 legs. Wave 2 can never travel more than 100% the distance traveled by wave 1. Rule 1. Wave 3 can never be the shortest, and wave 4 can never end in the price territory of wave 1. Well, the extended leg, in this case wave 3, should follow the same rules. Wave 2 can never travel more than 100% the distance traveled by wave 1, wave 3 can never be the shortest, and wave 4 can never end in the price territory of wave 1. This would be the extension. And the extension within the extension must follow the same rules. Wave 2 can never, blah, blah. You follow it, right? Okay, so now that answers, I believe, that answers one question that I didn't copy it. I saw it here. No, it wasn't here. I'm sorry. It was a question in YouTube where somebody asked me if one of the legs of the entire motive wave fails to follow the rules, then we cannot trade that. And well, now you have an answer. Obviously, you can't trade that because, well, that's not an impulse. If it doesn't follow the rules, and the extensions don't follow the rules, and the extensions within the extensions don't follow the rules, then you don't have an impulse. You have something weird there, and you don't know how to label it. But always remember this. If it is not a motive wave, there is only something else that it can be. And that is, if it's not a motive, must be corrective. And if it is corrective, corrections have a very particular thing. Corrections tend to be fully retraced. Let me explain why. Let's say, again, let's go to the to the same thing. This is wave 1 as an impulse, right? Correction would be wave 2. Well, eventually, doesn't matter if wave 2 becomes very long and now it turns into a flat. Remember a flat? It could be a flat, sure, like wave 2 could be a corrective flat. But eventually, it will be fully retraced because wave 3 would go all the way to the origin of wave 2. And the same occurs with wave 4. Wave 4 could be a zigzag, maybe it could be a triangle. It doesn't matter what it is, it will be fully retraced because eventually wave 5 will go beyond that. So corrections tend to be fully retraced. So when you identify, or let's say when you cannot identify an impulse, and instead, because if it's not an impulse, well, you could say, well, if it's not an impulse, it could be a diagonal. But if it is not a motive wave, then it has to be a correction. And if it is corrective, then it's got to be fully retraced. And that gives you a tremendous edge because now you know where the big move is going to happen, as long as you identify the correction. So let's say that you have something like this, right? So you don't know what that is. Well, does it look impulsive? Well, no. Does it look like a diagonal? Well, no. So, well, if it's not a motive moving down, must be a correction moving down. And if it is a correction moving down, it means that it's going to be fully retraced because the trend is in the opposite direction. That means that eventually that thing is going to be fully retraced. So you know that eventually prices are going to go there. And that is a wonderful thing to know. Just a second, let me take care of the questions. And yeah, the question is, are extensions only for impulses, or can we have extended diagonals, in which case possibility of overlap? Well, diagonals always overlap. Always. In fact, you expect the diagonal to overlap. Let's make the drawing of a diagonal again. Okay, this would be wave 1, this would be wave 2, this would be wave 3, this would be wave 4. It's inside wave 1, and this would be wave 5. So now let's put the line so you identify it better. Remember, we connect wave 1 and 3, and we connect wave 2 and 4. And there you have your diagonal. It's all overlappy. It overlaps everywhere. So now, in regard to the other side of the question, which is, are extensions only for impulses? The answer is no. In fact, extensions can apply to corrections as well. And extensions always add 4. So since corrections are 3, when there is an extension within a correction, we can add 4. And that means that now we will have a total of 7 waves. Well, this information is key. Why? Well, because if we have one of those situations, as I said, where all we can see are all the wiggles of the wave, and we cannot really differentiate which one is 1, which one is 2, which one is 3, because the internals are not clear. All we have is 1, 2, 3, 4, 5, 6, 7. Well, now we cannot say that this is an impulse because it has 7 waves. And that should give you pause, because if it is not an impulse, because if it has only 7 waves, it means that it's corrective. And if it is corrective, you know what it means. It means that it's going to be fully retraced, which means that this law will be tested. So, don't you find this extremely helpful for trading? It's really amazing. I don't know why people would not use this all the time. This is absolute gold for your analysis. So, now we know extensions can appear in corrections. They can appear in impulses. So they can be 7th or 9th. So now we have, before when we started, we said, well, 5s and 3s, and we differentiate 5 versus 3. But, well, now we can also think of 9th and 7th, or 13th and 11th, and so forth and so on. It's a very important thing to keep in mind. Now, here is one of the keys for when you are labeling a chart. A very practical thing. Something that is not part of the official theory of the wave principle. But it's a guideline that I call the Aldo guideline, because I have been the only one who promotes it. And that is that whenever we have an impulse, it's practically impossible to see all the internals of all those waves in the same time frame. You probably recall how we were on this chart and we were looking for, let's try to see if we find the subdivisions of wave 5, because on the monthly they were not very clear, so I suggested, well, let's go to the weekly. And if it's not clear in the weekly, well, we go to the daily, because we have to look for where do we find them clearly. But when there is an extension, if that leg is extended, it must show all the subdivisions within the same time frame. So if the third leg is the one that is extended, and let's say that this is a 60-minute chart, well, within the 60 minutes, we should see the 5 legs, often clearly. So, somebody says, how do we determine that one wave is longer than another? Is it based on the price difference from the start to the end of the wave, or does the steepness of the wave also matter? No, the steepness of the wave, it matters, but not for measuring the length. It matters to measure the speed, the intention, the personality. But let's say that this wave moved from 10 to 15, and the third wave moved from 5 to 25. Well, this one moved 5 and this moved 15. No, actually 20, right? So which one is bigger? Well, this one. So it's a difference in price, not the steepness. Although, as you said, the steepness will probably influence it, but indirectly, because as I said, impulses tend to be steep, very, very steep, right? They are almost vertical. So if they are almost vertical, that means that they are going to travel farther and faster, right? So typically those ones are going to be the one extended. And so typically we are going to find the subdivisions there. And Joe said, yes, if we can withstand the drawdown, it is surefire. Well, that depends if you enter in the wrong direction. No? I mean, there is no reason why you have to be in such a deep drawdown if you more or less follow the rules and guidelines of this. And there is a reason, because, as I said, when you trade using the Elliott wave principle, you know exactly where you're going to be wrong by 1 pip, by 1 tick. So you don't have to stay there suffering, thinking, am I right? Am I wrong? Is it going to turn back? You don't do that. Why? Well, because you know exactly where you are going to go wrong. So let's talk about that precisely. Let's talk about what is it that we trade using the wave principle. Well, let's go back to the original lesson, right? We had the core pattern, which is 8 wave cycle. 1, 2, 3, 4, 5, A, B, C. And we said that this is the whole wave principle. Right here, this is all. And I said it's so important to understand all this, because this pattern reproduces itself several times to form larger structures similar to itself. And it is that way that we call this 1, 2, and then we have the same thing reproduced again for wave 3 and then wave 4, and so forth and so on. But I also told you that this is going to be your trade setup. And that's why looking for this type of situation, it's probably the greatest exercise that you could make. Because once that you identify 5 waves in one direction that follow the 3 rules that we discussed, and that these 5 waves are followed by 3 counter trend waves, then we have a perfect setup. So here it is. We have here the 5 waves of an impulse. Which one of these, let's say that this is a larger degree, which one of these is the most ideal to trade? Well, in the wave principle, I think I mentioned that before, I'm not so sure, but we typically use the system of the fish, right? We don't take the tail, we don't eat the head, right, either, so we just eat the body, right? The same thing applies to the wave principle. You don't want to, well, maybe you do want, but you typically won't look for catching the turn. Some people ask me, how do you know where to catch the turn? Where do I buy after the ABC? And that's another question that we have. Actually, this one, I believe I wrote it here. Well, if I find it, I'll let you know. But the question is, we never try to catch a turn. So why not? Well, because we want to have high probability trades. So what we trade is, we trade wave 3s. Why wave 3s? Well, for one reason. Wave 3s tend to be the longer. They are not the longest necessarily, but they tend to be, they're called the wonders of nature. They tend to be the ones that achieve the most in the shortest amount of time. Therefore, they are the strongest waves. So you want to be there. So you want to trade wave 3s. And you want to trade wave 5s. And after that, well, you probably want to trade wave Cs. So of all the waves of the cycle, we want to trade only 3 waves. Wave 3, wave 5, and wave C. Why? Jose, thank you. My pleasure. I'm glad that this is helping you clarify the approach. So why do we do this? Well, one reason, as I said, is the probability that this is going to work in our favor. And another one is that by the time that wave 3 develops, the trend has been already established. Why? How? Well, for something that I have been telling you over and over again, which is that what establishes the trend is the cycle, the entire thing, right? This entire move here is what defines the trend for us. And if you remember, we mentioned that this was fractal. Therefore, this part here was the microscopic version of this and big version. In other words, this would be the microcosm and this would be the macrocosm. So once that we see here, we know that wave 1 must have 5 legs, right? And wave 2 must have 3 legs. So now we have here this in miniature. So we have the 8 wave cycle here. And what does it tell us? Well, it tells us that the trend is in the direction of wave 1. In other words, now we have a definition of a trend that is not dependent upon those higher highs, higher lows, even though it follows it. But now we have a definition of a trend that allows us to participate in the trend for the longest time and with the highest degree of confidence, with the highest degree of calmness, and with the highest degree of certainty. That's why I say that when you trade with the wave principle, you actually trade with the 3 C's, which is confidence, calmness, and certainty. So, and why is that? Well, because we have the trend defined. It is clearly established by the time it goes here. You see, by the time that, let's say that we had a wave, remember we have A, B, C here, right? So by the time that wave C forms, it's also forming a series of lower highs and lower lows. So traders that are looking at these, mostly non-Elliottians, they will be thinking, well, this is a series of higher lows and lower highs. Therefore, this is a downtrend. And so when they see wave 1, they think, another opportunity to sell. And because they do that, there are more sellers here. And that's the reason that wave 2 tends to be deep. And that's a very interesting point to add to why do we trade wave 3s. Because wave 2 tend to be deep. And because of that, the risk tends to be reduced. And the risk ratio reward tends to be increased. Now I'm going to explain that in more detail. And I want to know if you guys are following me, because I'm telling you things here that are so detailed that I'm not so sure if you're following me in so much detail. But let's discuss this risk reward ratio thing by specifically discussing where do we place our stops when we trade with Elliott waves? And already we know that we trade wave 3, we trade wave 5, and we trade wave Cs, right? Now, the placements for the stops, once we take those positions, is very clear and specific. It's so systematized that there is no question about, well, I don't want to put it here, I want to put it there. Apparently you're having problems with sound. Can anyone confirm that the sound is okay? Ullens Guido is saying, it's asking if it sounds okay for everybody. So I need to know, are you guys hearing me? Please confirm. Give me a yes or a heart. Love those hearts. Oh, it's okay. Okay. Thank you, Chris. Okay, so Ullens, apparently the sound is okay. Although I would love to have more hearts or more okays or more yeses. Sound is good, says Francis. So, sorry, but the sound is okay. Sound is perfectly fine, says Joe. Yes, it is clear, but we'll have to re-listen a few times to remember well. Well, yes, of course. There is a lot of materials here. And yes, you will have to listen to this several times. But let's go back to the where do we place the stops? Well, we place the stops according to the rules. So here's the thing. If we're going to trade wave 3, we know exactly where we're going to be wrong. Let's say that we wanted to buy this wave 3. Let's say that we saw here something that resembled a 5 waves up and a 3 waves down, right? And we said, I'm going to buy that. I'm going to give you an example momentarily for this. And you say, I'm going to buy that. Well, where is our stop? Well, our stop is exactly where the rules will invalidate this. We know that if we are correct, prices are going to travel much higher. But if we are incorrect, the law of wave 1 will be in jeopardy. Because we know if wave 2 is indeed wave 2, it can never travel more than 100% the distance traveled by wave 1. Therefore, a tick, a pip, right below the origin of wave 1 will indeed suffice as stop. So this is where you place your stop when you trade wave 3. And there is no question about it. You will place a stop. If you say, well, you know, I don't know, this is too big of a stop, I don't want to risk 1,000, I want to risk 700 instead. Well, if you risk 700, okay, that's good. But if wave 2 travel lower, it's still a wave 2. You will probably be stopped out, and then you will see a wave 3 going to the moon without you. And that's always so very painful. And that's the reason why only structural stops work. Money stops do not work. So when you trade using money stops, because people say very wisely, well, you know, you're risking money, so your stop must be money, and yeah, but that really doesn't make it, because you may be risking here, well, you only want to risk $200, all right, but if you risk $200 instead of 1,000 here, well, you probably will be stopped out. And if you're not stopped out, well, you probably were lucky. But do you want to trade with luck? Or do you want to trade with probabilities on your side? And that's the difference. That's why we trade so systematically. Everything about the wave principle, again, as I go back to that objection that I so often hear, is everything about the wave principle is very objective, very scientific, very measurable. We put the buy here, and we put the stop one tick below where it would be invalidated as a count. And that would be for trading wave 3. Now, how about for trading wave 5? Well, what's the rule? The rule says wave 1 can never end in the price territory of wave 1. So where do we put the stop? This time I'm going to ask you, do you guys can guess where do we place the stop if we're trading wave 5? And hint, use the rules. Okay, don't tell me, well, I would put it halfway through because halfway through sounds good. No, we use the rules. What would be the rule that would invalidate this as a wave 4 and, of course, lower the probabilities and possibilities that the wave 5 is going to develop? What would that rule be? Well, since you are not typing fast enough, I will tell you. That would be the third rule. What does the third rule tell us? It tells us wave 4 can never end in the price territory of wave 1. So what would be the price territory of wave 1? Right here. So if prices print one tick below wave 1, that would invalidate this as a wave 4, the entire structure as an impulse, and we would be wrong. Therefore, we would place a stop right there. Rick got it right. One tick below the top of wave 1. Congratulations. That means that you are following me. Thank you very much. Goes below the end of wave 2? No. Because if you put the stop below the wave 2, you're really increasing your risk for no reason at all. You would put it here. If it is a wave 4, it cannot travel below here. If it travels below there, let's say this is wave 4, and it goes like this, it's not wave 4 anymore. So why do you want to risk this? No need to. Make sense? Now, what's the next wave that we can trade? That would be wave C. Well, where do we put the stop? Well, if wave C is a wave C of a zigzag, obviously, let's assume that it's a zigzag, then we would put the stop at the top of wave 5. Why? Because of the same reason of 1, 2, 3. This is an ABC, and we know that in a zigzag, wave B travels pretty much in the middle lane, right? So we know that if wave B goes above here, we're wrong. There is no business for us to be trading that. And yes, you could tell me, well, but what is it if it is a flat? You told me yesterday that a flat could develop. Remember? And I say, yes, you're right. You caught me there. But I also told you that learning the formulas and the internals of zigzags and flats made a big difference, and hence I urged you to learn them. The difference is that a zigzag will have 5 legs down and 3 waves up, whereas a flat will have 3 legs down. And what did I tell you about threes? Well, threes are corrections. What did I tell you about corrections? Corrections tend to be fully retraced. If you only see a 3, that means that eventually it's going to be fully retraced. Okay, let's see. Always with probability and systematically. Betas able. Yes. Oh, you meant wave 1. Sorry about that. Yeah, so if you meant wave 1, you were correct. So now you guys know exactly where to place the stops. And so when you trade wave 3s, the stop now is very small here. And when you trade wave Cs, it's the same situation. When you trade wave 4s, the stops tend to be larger. Now, this has some advantages and disadvantages. Some people often ask me, what is the best wave to trade, because yes, I'm telling you, generally speaking, you want to trade wave 3s, wave 5s, and wave Cs. But personally, you need to get the wave that you feel most comfortable with. So you would become a better trader if you choose to trade only one of those legs. Instead of being all over the place trying to figure out what you're going to trade, you're going to choose one of them. Now, you will notice that whether you trade wave 3, you will have to have this, which was the core structure, which was the very first lesson. So whether this is 1, 2, and now 3, you have to have this. And if you are trading wave 5, well, this could be wave 3, 4, and 5. So you have to have this. And if you are trading wave C of a zigzag, you have to have the same thing, 5 down, 3 up, to be able to trade that wave C. So it doesn't matter which one of the legs you choose to trade, you have to have this. And that's the reason why I went through this and repeated this so often, and went back and explained it again, and then gave you the different rules for making sure that this is indeed valid, because not all 5 waves moving in one direction are valid as an impulse, or are valid as, to serve us to identify the trend with. And we want ones that are helping us to identify the trend. And in order to do that, they must follow the rules. And that's why those rules were so important to learn. Okay, so now you know exactly what to trade using the wave principle, and you know exactly where to place the stops. And you can see now that just by learning how to count to 5 and ABC, you are able to trade high probability setups without guessing. You can do that simply by confirming that the rules are followed, and without any guessing, you know exactly where to place your stops. Now, the stop placement can be refined, and if we have time, I will walk you through it. But these are the basics of the whole thing. Now that you have all that, you already know everything about impulses. You already know everything about extensions. You already know what to trade. You already know a trade setup which was based on this. I just didn't tell you exactly that it was based on this. But what I did was to tell you, let's use a channel here, remember? And if it coincides with stochastic crossing here, this is a great setup. And you can even make this setup even better, because the stochastic here is giving you the entry. And you can enter there one unit, let's say, whatever number of contracts or lots you use, but let's say you enter 1 unit, and when prices move above the channel, then you can add another unit. And when prices find support and move back above the previous high, you can add another unit. And when prices continue and take the main high there, now you can add another unit. And that way, you have managed your trade just by using the stochastic and channel setup. And you can see such a simple setup, but notice It's really worth noting that the entire thing was based on 5 waves up, 3 waves down. And I said, well, you don't even have to bother counting them, because all you need is to have something very elegant moving up, something very fast, something without overlaps, something very thin, followed by something very choppy and sloppy, right? And if that were to happen, you drew the channel, you put the stochastic, and there you go. I can give you an example, a clean, clear example of that happening right now on crude oil. Let's see. Let's use a 2-hour chart. Okay, so here we have, notice, something very fast followed by something very corrective-like, right? If you see these, would you say, well, this is a correction? Well, no. Why not? Well, because, let me make it a little bit bigger. Because, yeah, so we can expand it like this. Okay, so why not? Well, because without even counting the waves, which we could do, I mean, I think they are very, very simple. If you use the helicopter view, you would say from here to here, 1, 2, stop here, 3, 4, and 5. All right, we have 5 waves there, no question about it. And those 5 waves are followed by, well, guess what? An A, B, C. And remember how I told you, you think that this happens only in monthly charts or weekly charts? It happens everywhere. It happens in 30-second charts. This is the setup that happens all the time, everywhere. So when you have this, you have a great probability setup, right? So what do you have to do? Well, you see thin, fast, and you compare with this. Well, let's do very scientific and objective way of doing this, okay? I'm going to show you one way. You take this ruler here, okay? You take this and you put it here, and you go from here to the top, right? And then you say, well, how many bars it took this market to go from, let's say, from 55.89 all the way up to 62.60. Well, it took it 24 bars, right? And it was $7, something like that. Now, let's see how long has it taken to, don't even go half, right? Let's try. So from here to here, it took 56 bars. And 56 bar to not achieve even half of this move. So which one is slow? Well, obviously this one. Which one is fast? Well, obviously this one. Which one is thin? Well, obviously this one. Which one is fat? Well, obviously this one. Which one has overlaps? Well, obviously this one. Now, which one can be contained within parallel lines? Well, let's do this. Let's put that channel that I taught you before. There you have it. Well, and guess what? Now you add your stochastic, as I said, and when it gives you the entry, you will have a great probability trade here that would go above here, right? It's not like, oh, well, like typically, you see on traders saying, oh, well, it will target the next resistance here or the next trend line. Or, no, it's going to go way beyond here, because if this is a 1 and this is a 2, well, you know what's going to happen now. This entire thing, which is the core structure of the wave principle, is going to reproduce itself. And you know exactly what happened when it reproduces itself, right? It's going to bring a wave 3. Let's make it. Well, I'm going to do it like this. This time I'm going to make the drawing like this. All right? I follow prices there. And now what I'm going to do is to take it out of there so you can see it better. Apparently I can't. Well, I think even though the price is there, you can see 1, 2, 3, 4, 5, A, B, C. Well, as long as I can see, this is pretty much the same drawing I have been drawing and showing you for the past 4 days. Am I correct in assuming that this is the setup that we have been discussing? And the one that I explained yesterday is not a variation, it's a refinement of this. Because what you do is that, well, yes, you're going to enter in wave 2. But instead of waiting for instance, this is a 4-hour chart. Well, you can see the same thing in 1-hour chart, you know, if we do it like this, you will see the same thing, right? Depending upon how much you squeeze it. So here you have 1, 2. Now, what you could do here is move to a, let's say, let's make it interesting. Let's say that we want to do 7 minutes. No, that's 7 months. How do you do 7 minutes? Oh, there, like that. 7 minutes. Oh, will it do it or not? Let's see. Yeah, okay. So what you could do is to wait for an impulse there that has 5 waves. I think we have it there, 1, 2, 3, 4, 5. And then we have 3 waves down. And then, you know, if this is taken, you know that this is probably the 3rd wave, right? It's the beginning. But instead of doing that, I told you a way to enter with the stochastic. The stochastic here is far from giving the signal. And perhaps you're going to learn why. I think tomorrow you're going to learn why. And because we expect each one of these legs, wave 1, wave 2, wave 3, wave 4, they all relate to each other by some sort of Fibonacci ratio. And so we want to learn how do they relate to each other so we can confirm that they are indeed acting as the wave that they are representing. All right, so I think I have covered a lot tonight, and I believe now I'm ready to answer some questions. If you have questions, I'll be more than happy to answer your questions because, well, we are about to finish in tomorrow. We're going to apply very few more things, and you are going to get the entire wave principle in a nutshell. Yes, you may say, well, in a nutshell of a week. Well, certainly, but consider the fact that it takes months, if not years, for people to learn the wave principle. It took me more than 7 years, and it usually takes people more than 6 months to learn it, except when you have it, exposed to you in a simplified manner, as I have done, or as I have tried to do this week, and then you can really save a lot of time by learning that way. And so that's why I call it the wave principle in a nutshell. Okay, I'm not seeing any questions coming from you, therefore I'm going to say thank you very much for being with me. I'll be here again tomorrow at the same time, and we'll finish with all the details that are missing to complete the entire theory. All right? I hope that you have started to find that trade setup that I taught you yesterday useful, and that tomorrow you can even bring some of your experiences and tell me I made money, or I lost money, or why did I lose money, or whatever. I'll be very happy to answer your question. Do we use a pre-calculated take profit, for example, 1 to 2, or do we wait for the stochastic crossover again? No, we don't use pre-calculated things. And the reason is because, as I said, and let me put it in arrogant words, as Elliottians, we are scientists. We are not gamblers. So we know exactly where wave 3 is going to travel. We know exactly where wave 4 is going to retrace. We know exactly where wave 5 is likely to end. Therefore, we don't use those type of, okay, I take one risk and then 2 of profit. Nothing like that. Nothing even similar. Good evening to you, Gabriel. Can we use Heikin-Ashi? No, you can. Of course you can, but not for the wave principle. As I said, I think yesterday or the day before, there is only one type of chart that is appropriate to use for the wave principle, and those are bars. That's the only type of chart that can be used. Now, you can use Heikin-Ashi for other purposes. I use all kind of things. In fact, you probably can see one of my favorite things to use is point and figure, right? It's one of my most favorite things to use. But I don't use point and figure to use wave analysis because, well, doesn't work, right? So you need to use for the wave principle, you need to use bars, only bars. You cannot use candles, you cannot use Heikin-Ashi, you cannot use Renkos, etc., etc. Are those bars, are those charts bad? Absolutely not. They all have advantages. But for the wave principle, you need the highs, you need to see specifically the lows. You need to see the way that they form the waves, and you can only see that with bars. Cici says, great session. Well, great session. You made the session because your questions are what inspire me. Presented any better? Thank you, Professor. Could not have been any better. So concise and yet give us an overview. Oh, thank you so much for that. In crude chart, is to C, A is equal to C. So should we wait for a stochastic signal? Yes. Yes. Since you already know the wave principle, so I'm going to give you a little bit of an extra explanation here, right? To begin with, you always want to trade with momentum. If you try to take this trade here, let's label this again. We have said this is 1, 2, 3, 4, and 5, and this is an A, B, C, right? Let's say that this is incorrect degree, so let's make the right degree. I think it should be minute. Okay, so first of all, the A equals C is a wonderful guideline. Sure, that's a wonderful thing. It goes to 58.57. Okay, fabulous. This place is likely going to be offering severe support and probably sending prices up if it's not sending them already up, right? Now we know this is 58.50, right? But there are other measurements that are important to consider. Remember that number, 58.57, we said. Okay, so how about the 50 to 62%, right? So we have here, and well, 50% has already been achieved. The 62% is at 58. I cannot read it. 58.50. Okay, so 58.50 appears to be a good level also, but this is already in the area. Now we go to the stochastic. the stochastic still pointing down. If the stochastic is pointing down, let's say in a higher time frame, like in this case, you're going to be trading against momentum. And if you're going to be trading against momentum, you are probably, not necessarily for sure, but likely going to have a surprise to the downside or to the direction of the momentum. So if you're trading in an hourly chart, you can see momentum is still down. So yes, you need to have the confirmation of momentum. And in order to avoid all that, if you feel like, well, it's leaving me, it's going away. Well, first of all, remember, you have a distance similar from 55 or 56 to, I cannot read it again, I don't know why, to 62. Okay, we said $7. So what does it matter, 10 pips, 20 pips here? Doesn't really matter. You have like $10 of room to the upside. So you could do something else. And this, this makes difference in the approach. So we had the channel here. Okay, one thing that is not really good is that the channel is still far away from the low, right? That should give you pause. But there is something else. The 62% is right at the extreme of the channel. Well, that would be better. Not necessarily it's going to happen because this is already in the buying area. Here is where the buyers are, right? So this is already in the buying area. So what can you do? Well, you could wait for the upper boundary of the channel to be penetrated, and as I said before, ideally found support there. And then once that this is broken, so sometimes prices go like that. So once that this is broken, then you can add more. Once that this is broken, you can add still more. The other possibility, if you don't want to wait for the stochastic, which again, it's better to do so because you want to trade with momentum always. Trading without momentum is a recipe for disappointment because momentum goes against you. The longer term traders are against you, you will be in trouble. So let's say that momentum in, let's say a 10-minute chart, okay? And let's say the momentum here is to the upside. But if momentum here is to the downside, these are the longer term traders, and this is going to be hard for this to go up, right? So you want to trade with momentum align ideally. If that's not happening, well, you have other possibilities. As I said, you could easily wait for here is already, this already looks like an impulse, 1 2 3 4 5. You can pretty much see there, right? Look at this, 1 2 3 4 5. The ABC here down is not absolutely clear, but it seems like it retraces all the way to 88%. Let's look at it to see if that's the case. Yes, exactly 78%. Perfect. So breaking this would pretty much confirm a move to the upside that probably says, okay, this ended. But if I look from here, I would say, well, I see 1 2 3, or maybe this is a wave 4 still. And then maybe this wave 4 is going to form a triangle, something, and then come down and finally reach that 58.50 that we saw for the 62%, remember? Which was, let's put it in the higher time frame. And my apologies because I am answering in details to someone. I'm probably boring everybody else, but what I'm explaining here really works for everybody, even if you are not taking this trade or you are not trading this market. But for, what was his name? I think it was Miral who was asking this question. I hope that this helps you, Miral. Rick, thank you. Have a blessed day. Evening, take care, you too. Specifically, what insight do bars have over candles with Elliott wave? I suggest you go to the second presentation where I explain the reason why you need to use bars instead of candles, because candles are not the best. Yeah, you could say, yeah, but candles show you the opening and the close and the high and the low. Sure, it shows you that, but it also show you a large body that confuses the eye and messes up with the perception of the patterns. You no longer will be seeing something like this. You will be seeing something that may you believe that this is what is happening, and not happening, because you are just looking at, whether you want it or not, you're just looking at the bodies and not the shadows. Love you too, Miral. Thank you so much for those words. Miral says, thank you for a detailed answer. And if you need a more detailed answer, Miral, remember, I'm always ready and willing to serve and help you. So just ask, and I will give you all the answers you require. All right, guys, thank you so much. I say good night now, and I'll see you tomorrow. Thank you for explaining in detail. This helps in looking at further details. Yeah, that's correct. Well, you know, guys, I have presented you with the Elliott wave in a nutshell, as I said. But there are absolutely many details on trading that you need to know, that you must know. And particularly of the wave principle. The wave principle is deep. This thing has so many answers. This thing is like a complete universe within the universe of technical analysis. And don't take me wrong, the universe of technical analysis is phenomenal. The information that candles by themselves can give you is absolutely mind-blowing. That system was developed over 400 years. This is with observations that traders made, and really that is absolutely wise. But the wave principle is one of the additions to all the observations that had been made as technical analysis was becoming the science that it is, starting in the 1700s and then going into the late 1800s with Charles Dow, and then later on when Ralph Nelson Elliott in the mid-30s, 1930s, then he actually studied the Dow theory and realized that the Dow theory was missing quite a few refinements. And so the Elliott wave principle is basically an expansion, a refinement of the entire Dow theory. And of course, he incorporated into the whole thing the Fibonacci's and made the Fibonacci be the mathematical base of the entire principle, and incorporated many details that Dow, even though he made a phenomenal observation, Dow is known as the father of technical analysis because of his great and big contributions. But the wave principle is kind of the pinnacle, the culmination of all that. So that's why I consider the wave principle the absolute best, greatest tool that one can have, upon which you can build on every technique, strategy that you want. You can, as you could see, you add a point and figure. You could add trend lines. You can add moving averages, momentum oscillators. You can add indicators, whatever you want, but always on the canvas that the Elliott wave principle paints. Hope that helps you. Thank you so much, and I'll see you tomorrow.